Hello, everyone. I am Udit Verma, a corporate finance analyst at Wilson Partners, and today we are going to be speaking about a subject which is almost very crucial to every business owner out there, valuations. Today with us, we have two senior corporate financiers, Tyron Reinecke and Philip Atkinson. Would you like to briefly introduce yourselves?
Thanks, Udit. I'm Philip Atkinson. I lead the mergers and acquisitions and valuation work streams at Wilson Partners. I've been working in corporate finance full-time for over 30 years, both in public practice and industry in the UK and internationally.
Hi, thanks, Philip. I'm Tyron. I'm a senior manager in the corporate finance team. Got close to 15 years experience, and I assist Philip with the valuations on a day-to-day basis.
Thank you. So to jump into this conversation, why not we speak about why valuations are so crucial and what are the key purposes for stakeholders?
They provide an objective measure of a company's worth. They're used by multiple stakeholders. Investors use them to make informed investment decisions. Business owners use them to set their strategy and understand where they are in creating value and their ultimate exit. And regulators use them to make sure compliance with financial reporting standards. They're also used in a number of other areas such as mergers and acquisitions, for fundraising and for determining tax liabilities by the tax authorities.
And do you feel there is a correct time to seek a formal valuation for a company?
It depends on sort of various milestones in a business. The typical ones we see is a major fundraising event close to or pre-IPO. Mergers and acquisitions, anytime there's an employee stock option incentive or to be issued. We also see more regular valuations happening when, strategic internal planning or just for pure financial reporting.
And so we have startups and then we also have established businesses. Do you feel that the valuation needs differ in any way?
Yes, they differ, and it partly reflects their stage in their life cycle. So a startup valuation typically is based around future growth potential and the methods that are available, discounted cash flow, using something called the venture capital method or the cost to duplicate method. Whereas for an established business, you have a track record of earnings. It's about stability and profitability. And so you start to look at those maintainable earnings type methodologies.
Right. And could you speak to us a little more about how market conditions and economic cycles can affect a valuation?
Certainly. I think both significantly impact evaluation. If you think about economic booms, valuations tends to be higher. There's opportunistic, optimistic future growth expectations. Investor confidence is higher. Conversely, in an economic recession, these future projections tend to be more conservative, where you have got risk aversion that sort of increased. You take the COVID-19 pandemic for instance, that affected valuations negatively across the board. But if you look at the tech businesses, that increased their valuation as there was a sort of big push to go digital.
So on that note, how do you feel companies can effectively manage their valuations in the face of these market fluctuations?
I think there's a couple of things, but the three big ones is to try your best to diversify your revenue stream, to always try to, as best you can as a business owner, to have a good financial health in your business, and just communication with investors, I think, is also quite key in that.
So on the note of speaking about various stakeholders and their motives of getting a valuation, my next question is, do you feel that the purpose of a valuation can dictate the methodology used for evaluation?
Yes, I mean, the purpose of evaluation can dictate the most appropriate methodologies for fundraising. You're looking at a forward-focused methodology. It's about future growth prospects, whereas in M&A, quite often you're looking back at historical data and a more audit-based type approach, if you like, in looking at numbers that have actually been delivered and have been validated in some method.
Interesting. just some common misconceptions that you all have come across in business valuations in your career?
I think when people tend to think about valuations, I think it's very precise and it's a static figure. But realistically, it's just based on a set of assumptions that change as market conditions change. Another one we typically see that valuation needs to be higher. A higher valuation is more beneficial. That has got other lingering effects. There is the pressure to meet those growth objectives. The valuation perhaps might be attainable. That's the sort of things we see.
And how do you feel cultural and regional differences impact a valuation of a company?
Valuations typically are done around the globe. You have very different cultural influences, regulatory environments, availability of information, accounting has been brought into some closer or less divergent by using international financial reporting standards, but there's still a huge difference in variations in regional outlook for the valuation industry. What we're seeing is international valuation standards produced by the International Valuation Standards Council is trying to narrow that diversity and enhance usability of valuations, but they're not mandatory except for certain professional bodies that have signed up to those, such as the Royal Institute of Chartered Surveyors. But generally, there is quite a lot of disparity, and you have to rely on the valuers making sure that it's clear what their mandate is to deliver the valuation, and that they adequately explain their methodologies, approach, and how they reach their conclusion on value.
So, can you tell us a little more about some, emerging trends that you see in valuation in today's world?
So some of the points might be, what we see is data analytics coming into play, artificial intelligence becoming, more and more a factor as they try to make valuations more precise and more efficient, I guess. ESG is also a big factor as investors try to look for a sustainable method in evaluating a business. Digital assets, cryptocurrencies is also on the rise, and and I guess that's sort of pushing the valuation framework to develop more in order to try and value these novel asset classes.
Thank you, Philip. Thank you, Tyron, for your time. If you have any more questions regarding valuations, please do feel free to get in touch.